Hi everyone. I wanted to take a moment and illustrate a capital budgeting example where we have a new product introduction. Okay, and really this is a case of where we're computing the relevant costs and we're trying to evaluate whether this new product makes sense to do. And perhaps at the end we can talk about other ways that you could use a model like this for other types of capital budgeting decisions, other situations where time value of money concepts like net present value and internal rate of return can apply to decisions that you need to make for a business with regard to the best use of capital, and how companies should consider they spend their capital given that they have competing projects and competing opportunities for that capital. Okay, so in this case I've got a model that's put together and all of this is made up, but I've used these in the past. Okay, so we're going to assume in this case that we have a new product available to the firm, and in order to introduce this new product there's some costs in year zero. Year zero means right now, right? We're on a time frame, so these are all the end of year one, end of year two, and so on. But at year zero, what we know is that we expect to start spending $1.5 million, keep in mind dollars are in thousands, immediately. We also think we're going to need to incur $400,000 in capital and other startup costs as well. Now, I do have something prepared inconsistently here because all these are outflows and costs appearing down to total costs. I have them appearing in positive numbers, and then down here I've shown some other initial cash outflows in negative numbers. Now you could adjust for that, right? But since I've prepared it this way, I'll go ahead and work with it just as it's designed. Okay, so we need to spend $400,000 on working capital immediately, and that may be to buy inventory and supplies to support our new product. We may need to buy parts to make it, items like that. We really don't know a whole lot. And then some analysis has been done that says, we're going to need an additional $300,000 for other costs. Now, I'm not sure what that is, but we'll assume that there was some reasonable analysis put into that decision. And finally, we need to spend $5 million on equipment. Now, this could be a new plant. It could be equipment. The whole idea is these are long-term capital items of $5 million. Okay, with that in mind, we need to know a couple other things. There's been a depreciation on that incremental equipment, and that depreciation shows up here is tax depreciation, and the dollar amounts that are calculated here would represent the tax depreciation allowed per the tax code. So you would go search online for probably MACRS, the Modified Accelerated Cost Recovery System, and you would come up with what the depreciation allowances are to compute that tax depreciation. For purpose of this demo, it's 15%, 30%, 30, 15, and then whatever balance is remaining in the fifth year. Okay? And these numbers are made up. They probably did not come from MACRS. I really can't remember where I pulled this from. But assume that it needs to come from a MACRS schedule or whatever other appropriate tax authority or tax policy tells you what the tax depreciation would be. Okay, but if I sum all of these, that total is that $5 million that appears right here. Okay, then what we would do is we'd put an analysis together that says, well, these are what we think the revenues would be, right? And this keeps on going. By the way, if I slide over, you'll see that we're going through 10 years. Okay, let me slide back. And then you would indicate what are the incremental, which means relevant cost related to this. And in our case, you have to identify these on your own. You have to think about it and put together what you think the relevant costs are. So we assume we need to hire a new product manager, and the new product manager's salary looks like $110,000 for the first year, and then he's got about a 3% raise thereafter. And this goes out 10 years, although you can't see it. And then we assume that there is a bonus that won't kick in until year 3. And here's why. It was modeled that says he doesn't get a bonus unless he exceeds 6 million in sales. Okay, and in this case, if he exceeds 6 million in sales, the new product manager gets a 2% bonus. So then once now we're ahead of 6 million, we've got a bonus to factor in every year. Okay, then we've 30% fringe benefits for the new product manager. So we just take the salary times the 30%, and I think we assume the bonus isn't included in the base of that fringe. And that's an okay assumption. If it's unrealistic, use another. Okay, then we also assume we'll need to take on a new lease for warehousing the product, and it looks like it's a fixed lease over time, $200,000. Though once we get to year 6, sales are big enough that we think we need to incur additional capacity for leasing. And there's also an assumption that the new product requires that we pay a royalty to someone. So we must have not designed the product, we must have bought it. And as terms of the agreement, it looks like we've got a 1% of net sales that have to be paid in royalty. Okay, now the cost you come up with depend on the circumstances of the new product introduction you have. Okay, then we have advertising, $1.5 million, very heavy in the first year, and then advertising seems to be 3% of sales. Okay, going on, the depreciation runs for 5 years maker's class. And I do want to slide over and show a couple other things before we go through the formula here. Oh, yeah. I want to show that at the end of our project, which we think is only going to last 10 years, we will liquidate that investment in working capital. So if that was made up of inventory and supplies, we're assuming we'll use them all up or sell them off and get the entire benefit. And that's why we've got a 400,000 positive number appearing in cell M24. Okay, now the other startup cost, of course, we don't recover. That's money, that 300,000 is gone now. And also, let me slide over again, this 50 here represents the salvage value of the equipment. So we think at the 10 years we can either find an alternative use for this product that's worth 50,000 to us, or we sell it to somebody else and get 50,000 in proceeds. Okay, so you need to factor in salvage value of what happens at the end. And this is just one way of modeling the termination of a project. There's a few other approaches that you could use depending on the nature of the project you're evaluating. Okay, now what do? We come down and we calculate the total cost, right, and come up with the net cash flow. And so we're going to spend $7.2 million in the first year. Then we add up the cost. We have operating income. We have a 40% tax, so we multiply that times operating to come up with net operating profit after tax. Now, since depreciation was deducted above, and that doesn't represent a cash flow, but the tax code allows us to record it, there is a tax shield on depreciation. In fact, why don't I write this in? This is going to be the tax shield from depreciation. Okay? And this is one way you can calculate it. You then take the depreciation and add it back after you've computed the net operating profits, right? Because that 283 considered the tax shield from depreciation. Actually, you know, this technically isn't the tax shield from depreciation. Technically, the tax shield from depreciation would be the 750 times the 40%. But rather than computing that as one line item, instead, I'm choosing to model this by showing the full deduction is a decrease in cash flows, and then we add back the depreciation afterwards. And so what happens is the net impact of income tax gets included in the analysis. Okay, so that then once we add in the net operating profit after taxes and add back the depreciation, which really doesn't reflect cash out of pocket, we're able to come up with cash flow from operations before other items, and we can sum that going forward. Okay, and then of course in the last, then we just come up with our net cash flow. Now in the first year, we were out 7.2, and then we have some positive numbers. All right, well once we have that, we could compute payback, right? And all I'm doing here is taking the cumulative payback to come up with how negative are we. So here we're negative. Again, we're getting positive, right? Because we were 6,026,000 negative. Now we add 1,688,000 as a result of our operations for year 2. So now we're only negative 4.338. And if we copy that formula going forward, we eventually can compute that break-even occurs. Let's compute. This is after 1 year, after 2 years, after 3 years, after 4 years. So this isn't really correct. Let's go ahead and compute that. It's really 4 years. I'm going to put the formula in here, right? Because we're still negative. 1, 2, 3, 4. And then we have 4 years. And then we need to subtract out, I think it's H28. What's in cell H28 divided by I27. And what we're doing is computing the percentage of the years we have left. So actually, let me take a look again. This is 4 years. Oh, I'm sorry. I did have that right, other than one little error. Let me undo this. Undo it one more time. All right, so 4 plus, we take the value in G28, which is 634, and divide it by 1833, which is the full year positive, to come up with a partial year. And so we have 4 years plus a partial year. So payback is 4.3 years. Now NPV, I'm going to hit that formula. All we're doing is we're taking a 13% cost of capital. Oh, I didn't jot that down anyway. That would have to be given. The appropriate cost of capital or appropriate risk-adjusted discount rate for this particular project for this company is 13%. And then we sum the net cash flows that we've modeled. And what I'm doing is I sum from the end of the first year through the end of the 10th year. You can see this here. And then, of course, we add back the cash flow we spend right now. And you definitely want to add that. You want to include that as an add back to now. If you leave it within the NPV formula, it would assume that 7.2 million that's spent in the first year is actually spent at the end of the first year. So you don't want to make that error. Okay, so with that, we have a net present value of almost $1.9 million, which says shareholders are better off if we take this project than if we don't take it on, and they're better off to the tune of $1.9 million. Now with internal rate of return, we just run the numbers through C27, through cells M27, and for the guess, I use that 13%. And it comes up with an internal rate of return of 18.9. And since that's higher than 13%, again, it's concluding that this is a good project. Okay, now let me talk just for a minute how you might want to use an analysis like this for another project. Let's assume that we have two different projects, but both don't have revenues. In other words, one may be a decision to take on a new floor space, and another may be to buy a piece of equipment. Or perhaps we're looking at two different pieces of equipment. Or perhaps we're evaluating the valuation of outsourcing one versus the other. Okay, the point is, in an analysis like that, you wouldn't have revenues, right? So all of these numbers would go to 0. And I'll just go ahead and make them 0. Before I do that, I do want to save my my spreadsheet here. So give me 1 second, because then I'm going to make some changes. But if I take that to 0, we'll get negative numbers. But then what you would do is you would say this is case 1, and you'd lay out all the incremental costs. Now, you wouldn't need to worry about internal rate of return or payback because they're only outflows. But what you would be able to calculate is a net present value, which tells you in today's dollars this is what alternative 1 would cost. Then what you could do is copy this whole analysis, right? Run it again for the second alternative and compare one alternative to the other. And obviously the one with the lower cost is the from a quantitative point of view would be the better alternative to take. Okay, so what does this mean? Well, it essentially means that we're choosing among cost alternatives with the one that has the lowest cost, and we're using the time value of money to bring all the costs to the present value so that we are making an appropriate apples to apples comparison. If we don't use the time value of money and the cash flows differ between the years, just basing it on the total cost spent in total years may not give you the right decision rule to use. So the point I want to make here is you can use this kind of model as well for just cost alternatives. Just do one analysis, compare it to another. You could compare many, and the lowest cost in terms of net present value, after you consider things like the incremental depreciation and the tax yield from the depreciation, that should get you the best answer. Okay, everyone. I hope this has been helpful. Thank you.